What is the difference between margin and leverage? Your hungry stomach is craving for the delicious biryani in the nearby outlet. But your empty pocket. A friend lends you money for the meal. How do you feel? Undoubtedly you'll be on cloud 9. That person is like an angel in disguise, isn't it? There may be times when you may see a low-hanging fruit in front of you but may not have the resources to pursue it. That's where it becomes critical to have someone help you avail these opportunities, in spite of limited funds at hand. And the stock markets are no different from real life. So the goodies we get in real life apply to it as well. And these kinds of opportunities, in market parlance, are termed as margins and leverage. Firstly, let's define what margin is. In trading, margin refers to the amount of money that a trader needs to set aside in their account to open and maintain a position. It acts as a security deposit, ensuring that the trader can cover potential losses. Simply put, it's the collateral you need to have in your account to make trades. Explanation of how margin works. When you trade on margin, you are essentially borrowing funds from your broker to increase your position size. This allows you to control a larger position with a relatively smaller amount of capital. However, it's crucial to remember that while margin can amplify potential profits, it also magnifies potential losses. So, it's a double-edged sword that requires careful risk management. Now, let's shift our focus to leverage. Leverage is the ratio of the size of a position to the margin required. In other words, it's the ability to control a large position in the market with a smaller amount of capital. Leverage is expressed as a ratio, such as 10:1 or 50:1, indicating how much larger your position is compared to your margin. Comparison of margin and leverage. So, what's the difference between margin and leverage? Well, margin is the actual amount of money you need to deposit, while leverage is the ratio of the position size to that margin. In essence, margin is the cash you put down, and leverage is the borrowing capacity it provides. Let's walk through a quick example to illustrate these concepts. Imagine you have ₹1,000 in your trading account, and you want to open a position with a 10:1 leverage. This means you can control a position worth ₹10,000 with your ₹1,000 margin. If the trade goes in your favor, the potential profit is based on the entire ₹10,000 position, not just your initial ₹1,000. While leverage can magnify gains, it's important to highlight the risks involved. A small adverse price movement can result in significant losses, and traders can even lose more than their initial investment. This is why understanding and implementing proper risk management strategies are crucial when trading on margin with leverage. In summary, margin and leverage are fundamental concepts in trading. Margin is the amount of money you need to deposit, while leverage is the ratio of your position size to that margin. Both can be powerful tools when used wisely, but they come with inherent risks. As always, make sure to educate yourself, practice responsible trading, and never risk more than you can afford to lose. That's it for today's video. If you found this information helpful, don't forget to give it a thumbs up, subscribe to our channel, and hit the notification bell to stay updated on our latest content. Until next time, happy trading.